Are you unknowingly leaving money on the table because you don't know your gross profit margin?
Over 60% of small businesses don't know how to calculate their gross profit margin properly, and as a result, it's costing them thousands. What if the key to boosting your profits, it isn't by working harder, but it's just by knowing your numbers? Most business owners feel like revenue is the ultimate factor in success, and frankly speaking,
focusing on gross profit margin is by far the smarter, more profitable, and more sustainable way.
If you've ever wondered how much you're actually keeping after covering your direct costs or where you stand against your competitors, you're not alone. Many people that we speak with have no idea how to calculate those numbers. Frankly, many people avoid it simply because they just don't know how to calculate it. So let's make it simple. There are 3 steps that you get to take to calculate and improve your gross profit margin.
Number 1, calculate your gross profit margin. If you are unfamiliar with where to pull this information, you should go to your bookkeeping software. This is QuickBooks Online. This could be Xero. It could be the Excel spreadsheet that you use, or the pen and paper if you haven't come out of the Stone Ages. If you don't know where this information is, ask your bookkeeper. If you don't have a bookkeeper, you are the bookkeeper. If you don't have this information categorized, that's a conversation for a whole other day. But we're going to operate under the assumption that you do actually have books that are being updated. So what you're going to do is go into your bookkeeping software and you are going to pull your profit and loss statement,
also known as your income statement. All right, you're going to pull that up. Every income statement has the same generic categories, whether you're in construction,
home services, trades, content creation, financial services.
It doesn't matter. The general structure is the same. And what you want to do is go to the section. It's going to be 3 main sections down. It's going to go revenue, cost of goods sold, gross profit. You want to take that gross profit number and you want to divide it by your revenue number. And what this gives you is your percentage.
That's it. Take your gross profit and divide it by your revenue so you get your gross profit margin. It's that simple.
Now, here's where it becomes a little bit more complicated. The second step toward improving your gross profit margin is to compare yourself to industry standards. So there's a few things that you get to do. You can either
go online and ask for industry trends. What is the general gross profit margin for plumbers in the United States? Google will tell you. ChatGPT will tell you. What's that range? Now, what you get to do is compare that percentage to your percentage. If you are lower, you got some work to do, baby. All right? Now, don't just look at Google.
If there's any specific trade associations that you're part of, networking groups that you're part of, maybe you have friends in the same business as you, ask them what their profit margin is as well and see where you guys stand
in comparison to one another,
because chances are you have something to learn from each other.
Now that you have the percentage,
you have the benchmark. Step number 3, increase your margins strategically. There are 3 things that you get to do to improve your margin. Number 1, negotiate better supplier deals. When's the last time you talked with your vendor?
Your manufacturer? When's the last time you asked for better payment terms or better discounts when you buy in bulk? Now's your opportunity to do so.
Number 2, streamline your operations. So cut any inefficiencies in your production or service delivery. So if there's any issue or hiccups where you're leaving money on the table operationally, and I'm talking about maybe the delivery of those costs of goods, or maybe you have people that are outsourced that really aren't doing their job the way that they should be, or maybe internally, you got to cut those so that way you can boost your bottom line. And then lastly, the 3rd step here is focus on high profit products or services. So if you're in a business where you provide a few different verticals of revenue, so let's just say for somebody who's in the construction space, maybe they focus on doing playgrounds, but then because the work for playgrounds also is very transferable to doing basketball courts, right? Which one is more profitable? If the basketball courts are more profitable, then you should be focusing your efforts on selling those and doubling down on those revenue streams because they have more profit already baked into it, rather than focusing the marketing on the playground side. You see, you're not going to be able to
know which vertical in your business, how you make your money in your business, which one makes the most profit if you're not looking at your numbers on a per type basis. So your books should really say revenue, but then they should have revenue from this type of vertical, revenue from this one, that one. That way you can see where all of your money is coming from and then start breaking down which ones are the best use of your time. Here are 3 mistakes to avoid. Ignore indirect costs, or ignoring indirect costs that actually impact your pricing strategies. Sometimes there are costs in your business that maybe aren't considered a cost of good, but they really are a cost of good. Don't ignore the items that you often forget about or you kind of oversee. This can be things like the cost of having an additional truck in your fleet, okay? If it's not getting put to use, it's not making you any money. Same thing with equipment. Second thing is using outdated or incomplete financial data for calculations. I referenced this a little earlier in the video. If you don't have accurate books, you're not going to be able to make better financial decisions, and that's just the hard truth. So get your books up to date.
If you don't know how, reach out to us. We're happy to just guide you, okay? And then third, trying to match industry benchmarks without actually understanding your unique value proposition. And so what this means is, if you are just comparing yourself to industry standards, but you do things differently, and by doing things differently, it means you get a certain type of clientele, you don't always want to take it as gospel, whatever it is that you find online. You need to ask yourself, well, what is it that the industry is doing in comparison to what I am doing? How am I different? How am I setting myself apart? And give yourself the opportunity to ask those challenging questions before you just start eliminating costs that might end up hurting your brand. Knowing your gross profit margin is just one piece of the puzzle. I invite you to come back next week. We're going to drop an additional video where we're going to talk about bill processing payments and helping you with your cash flow. Don't miss it.